right, good afternoon, everybody. I'm David Huff with DW Huff Consulting, bringing you the March 17th, 2023 edition of News from the Front Lines of Business. So here we are again, another week in the bag here, and a lot of going on. So we got this big deal going on with the bank collapses. So we've heard probably a good bit of news lately with Silicon Valley Bank, and I think First Republic Bank dropped a little bit earlier. And I think there's a lot of fear, about the bank deposits, particularly if you have more than $250,000 in a bank, and you are considering the possibility of, having some of your money at risk due to exceeding those insurance thresholds. But while it is possible, I guess it's worth backtracking a little bit and trying to understand why this happened. So. Going back to the COVID year, so this is something that I borrowed from another tax attorney who teaches a lot of tax planning courses and overall financial planning type things, and he got this from a guy named Sean King. So this is not my ideas here, but I'm going to go ahead and summarize a few that kind of jumped out at me. So COVID-19, we have a lot of government stimulus going out there, right? So different payments, different PPP loans, and certain benefits to certain types of industries to kind of keep them going to get through the shutdown period. So a lot of liquidity. In a lot of cases, these businesses borrowed money and didn't need it immediately, so parked it in bank accounts. So that's what we see here. All of a sudden, got a lot of liquidity. These companies couldn't put it to work right away, so they parked it in bank accounts, which caused another problem. So the banks have these deposits now. They could not turn around and lend this stuff out fast enough, so they ended up with a lot of idle cash that they had to do something with. So most banks looking to increase their investment returns a little bit to make things a little better for future quarters. Went into various fixed income investments. So in the case of not just this bank, but all banks, right? They went to treasuries because treasuries are said to be kind of safe, right? So they, so they went out there and they got some of these bonds that had a little bit higher interest rate yield, and the reason why they would do this as opposed to an ordinary, even shorter term investment, is because what's going on behind the scenes is that the Fed here is promising them that, and it's unofficial promise, I guess, that could blow up on you, but they were basically promising these big banks and these big financial institutions that they weren't going to raise interest rates until 2024. So, and we kind of see, you've probably seen an explanation where interest rates rise, so the value of your bonds go down. And then, so if you have to sell that bond early, now you're not going to get the same amount of money for it when you redeem it as you paid for it. So you're going to have a loss on those bonds when interest rates rise. But due to the fact that they had this kind of unofficial promise that we had a couple of years to go before the interest rates could possibly rise again, it seemed like a no-brainer to try and squeeze a couple extra percentage points return out of your fixed income holdings. So that's what they did. All right, so now you got all this money tied up in treasury bonds, and as politically we see there's some action here to bring inflation down to kind of affect people's perception of things at the polls, which happened. And then lo and behold, as we get out of here a little bit later on down the line, we have a lot of problems, liquidity concerns. So what basically ended up happening is, I guess as the rumor mill kind of starts to work, some people got a little bit concerned and started pulling their money out of this bank. So as money came out of it, more and more people also started to pile on and also try to pull money out, and which caused the bank to have to sell more of these fixed income securities. And the reason why this is such a surprise is kind of shown here in point number 11. Ordinarily, when banks and financial institutions have investments, in their financial statements, it's disclosed when they have a big loss in value. So if they had a whole bunch of, say, shares of stock in a company, and those were substantially down in value, there wouldn't be any loss recognized on the books, but there may be a footnote saying, hey, we got these stocks on the books at $100 per share, and now they're only worth $50. So take that into consideration when you're looking at the viability and investment suitability of this company. So that was kind of not done with this case, because with this particular type of bond, if you recategorize it as a held to maturity security as opposed to just regular security, you don't have to do that mark-to-market adjustment for the unrealized losses. So on paper, they were looking really strong, but in reality, the bond portfolio had went down substantially in value, and that would have this may have happened a lot earlier if people would have been privy to the fact that the portfolio was made up of a substantial amount of these bonds that were affected by the interest. So that's what it was. At the end of the day, a lot of nonsense going on behind the scenes with promises from government entities, accounting trickery, and now we got people who have lost money. So there are investors and stockholders and bondholders that have lost money now in a bank, and most of the I guess deposit account holders have been made mostly whole, I think. But by and large, there is some pain. There will be more fallout. Another bank went down today. I think there were a couple more kind of on the ropes. So I guess at the end of the day, that's the explanation here, is that we've got a lot of fractional reserve banking is a term we see. So normally banks will borrow money from the central bank here, the Fed. They'll borrow money and turn around and resell, but they only have to hold. So if they're going to lend out $100, in order to do that, they only have to have $10 of actual cash money. So it gets a little potentially crazy, because money comes in, they're lending out 10 times whatever the deposits were. So you can kind of see that at any given time, the money that they lend out is really not in the bank able to be withdrawn. It's out in other people's portfolio who they lent it to, who those people have gone out and encumbered it with real estate investments and fixed assets and things like that. So there's no way to get the money back out of the bank quickly in most cases. If everybody goes to the bank at one time trying to get the money out, it's impossible, because the money is gone. It's lent out. It's and that's why this fractional reserve banking is so scary, I guess, because with that 10% rule, and they're lending out 10 times the value of the real money, and the real money is also going to loans. Like, you can see how this would be bad. So if that bank can't go out and borrow more money to repay the people who are asking for a return of their principal, it gets bad pretty quickly, and that's what's happening. But it doesn't necessarily need to be that way. In theory, there really shouldn't be any need to really be pulling the money out of the bank account. As far as the safety of it goes, we could be pretty safe, that pretty much assured that the banks aren't going to go under, in a widespread, systemic way. So, but another option that people give you for protecting your money is not having it all in one account. So you move things to several different institutions, so it's not all in one place. That's one way you protect yourself, as well as other types of investments. So not having it all tied up in cash. There are certain types of bond issues and CDs. There are certain other things out there that don't have the same risk that you could consider. So there's that. Another discussion we've had this week that's somewhat useful. We talk about retirement plan savings and all, and the 401k being the biggest of them all. And we looked at this one study here that shows the average balance in a 401k at this point in time. So here we're looking at they showing the total average is 103.9, 104,000, let's call it. And not surprisingly, when you break it down a little bit further by age group, we see that the baby boomers have more in their accounts than the Generation Z people who are kind of just entering the workforce. So I find that a little bit interesting that the 401k balances are that low, in my opinion, because the boomers and all, I would expect that to be probably double it. But let's look a little bit further into the fine print here. We see that this does not include things like IRAs and other regular brokerage accounts. This is strictly workplace 401ks. So that could be good or bad, I guess, because we know that the 401ks have a little bit higher operating expenses than most of these other IRAs. So the odds are pretty good that hopefully people have other sources of retirement income, because the 401ks by themselves don't really seem to be sufficient. So follow our advice. Have some rental properties, have some Roth IRAs, have some other things out there, and don't just rely on a 401k, which I guess this study seems to indicate that that is what's happening. So anyway, that's it. Ides of March 15th. That deadline is now behind us. S corps and partnerships are what we're talking about there. But they still got the main deadline is April 18th this year for everybody else. So that's still in the works. So it's our C corporations, and of course our regular individual returns are subject to that. So yeah, so it'd be get your stuff in if you haven't already done so. And I'm so worn out right now. Can't even think straight. But so closing thoughts. So this week has been rough a little bit. A friend of ours, young daughter, passed away, kind of suddenly. Then last night, another friend of ours, an athlete back in the day, but another 50-ish year old guy like me, passed away very unexpectedly and suddenly of a heart attack. So just kind of goes with the theme of the past few weeks. It seems like a lot more people have been passing away than typical. But just kind of I guess taking advantage of the days you have here. So we have this Marcus Aurelius quote: "You may leave this life at any moment. Have this possibility in your mind in all that you do or say or think." So yeah, you can leave today or tomorrow. So take advantage of the good stuff you got going on now. Don't think about the bad stuff, because it's all going to come to end for all of us sometimes, possibly unexpectedly. So live the good life. So with that, enjoy the weekend. A little bit rainy over here, so I don't know what. That doesn't matter. I'll be inside doing taxes anyways. Who cares? So, but anyway, you guys have a good time, and we'll see you next week.